Thank you for joining us at XM.com for today's market comment by Harlan Bospisuros. I'm Maria Bashurdes. The euro extended its recovery against its U.S. counterpart on Monday, bolstered by more relatively hawkish ECB rhetoric. Just a day after the ECB's decision was interpreted as hinting at the end of this tightening crusade, several policymakers, including President Lagarde, appeared in their hawkish suits, noting that further hikes cannot be ruled out and pushing against market expectations of rate cuts for next year. What may have also helped the euro was news that the ECB may soon start discussing how to tackle the multi-trillion euro pool of excess liquidity, which counters the impact of the ECB rate hikes by reducing competition for deposits among commercial banks. Although euro-dollar returned and closed back above the key 106.65 zone, it seems that investors want more assurance that there will be no rate reductions next year. They are currently pricing in more than 50 basis points worth of rate cuts. Perhaps they prefer to place more trust in the upcoming data, as the latest results have been far from encouraging for the Eurozone economy. The next set of indicators that may come under scrutiny are Friday's preliminary PMIs for September. The dollar pulled back against most of its major peers on Monday, but it's fractionally higher today. Perhaps dollar traders are reluctant to assume large positions ahead of tomorrow's FOMC decision. The committee is widely anticipated to stand pat, and there is only around a 45% probability for another hike before the end credits of this tightening series roll. Despite the US being in better shape than other major economies, investors are still pricing in nearly 80 basis points worth of rate reductions for next year. Thus, if officials keep their hands off the hike button, the attention is likely to fall on the updated economic projections and the new dot plot. On Wall Street, both the Dow Jones and the Nasdaq closed virtually unchanged, with the S&P 500 gaining only 0.0%. Like dollar traders, equity investors have likely adopted a cautious strategy ahead of the FOMC decision. Gold took advantage of the pullback in the US dollar and Treasury yields and climbed above the 1930 zone. Even when the dollar was on the front foot against all its major peers and Treasury yields were soaring, gold was not hurt that much, and this is evident by the fact that it's currently floating at levels less than 8% below its record highs. Thanks for watching today's market comment here at XM.com.